Well, welcome back. Time for the word on Wall Street. Top investors watching your money. Joining me right now, Infrastructure Capital Advisors CEO and ICAP ETF portfolio manager Jay Hatfield is here. Bell Point Chief Strategist David Nelson is here. Great to see you guys this morning. Thank you so much for being here. David, kicking things off with you, with a market that is pulling back after another rally yesterday. We're looking ahead to more earnings, but probably the biggest mover for this market has been the Fed. Look, we're waiting on CVS, Uber. They already reported double beats this morning. Earnings per share and revenue strong. The stocks are trading up, but we're looking ahead to Disney, which will report after the bell, which will give us a good window into what's going on in the macro story. What did you take away from the Fed, and where do you think is driving markets right now?
I think, we're still hostage to the Fed. We still hang on every word. Even yesterday, we had 100 basis points move in both directions, up, down, and finally close at the highs. I think for the first time, markets are starting to believe the Fed because interest rate futures are pricing in a terminal rate above 5%. That's kind of in line with their thinking. And yet the cuts that we were all expecting, they're kind of pricing that out, and yet markets closed pretty close to the highs. I think markets are starting to get comfortable that maybe we can live with elevated rates for some time.
You want to buy stocks here?
I own stocks here. I'm pretty fully invested at this point. You got 70% of stocks are trading above the 200-day moving average. If you're not in right now, you've missed a big part of this. Well,
you certainly missed this year, beginning of the year rally, Jay, even with all these cuts that we're hearing about from job cuts. Zoom this morning, the latest, saying that it's going to lay off 15% of the workforce as the company prepares for the, quote, uncertainty of the global economy. eBay cutting 4% of its workforce, also due to the state of the global economy. Jay, what's your take on the labor market, and what kind of sentiment are you seeing in your ETFs?
Right. Well, I should say first, thanks for having me on. But we have been way more bullish than most people coming into this year. Our target on the S&P is 4,500. Wow. Having said that, we've actually come pretty far, pretty fast. And it's always critical for investors to recognize it's better to be long stocks during earnings season. So then the companies are controlling the dialogue versus being buffeted by macro developments and by Fed speak, which is going to tend to be bearish. But in terms of employment, I'm not too concerned about tech layoffs. I was born in Silicon Valley. Those workers are all highly trained. They can get remote work. What you don't want to see is mass layoffs, and we've talked about this before, in the housing sector and autos. Those are lower skilled workers concentrated in the Midwest, hard to reemploy. That's what normally gives rise to a recession. And that's why the Fed is concerned. We think they're completely off base. They're focused on the Phillips curve. They think that employment needs to come down to reduce inflation, which is just not the case.
So do you think employment does come down, or we continue to see this job creation month after month?
Well, that's one reason.
Can't have a recession with that kind of job creation, right?
Correct. And that's why even for almost the last 6 months to a year, we've been saying soft landing because of the strong labor market. And what's different about this cycle, because like I said before, 11 out of 11 recessions have been preceded by an inversion. But here, we're post-pandemic. So you have post-pandemic tailwinds that are keeping employment high, but yet the Fed has shrunk the money supply. Housing is coming down. There's been a big energy price deflation. That's critical. That was really the inflation of the 70s were caused by high housing prices and two gigantic energy shocks. So both of those things are unwinding. So we think the Fed should be way more optimistic about inflation. That's why we think the market's rallying. Having said that, I think we could stall, but I think the risk reward is that we go higher than 4,500. I could easily
higher than 4,500.
And we're at 4,160 right now.
Yeah, now I'm not saying that's the fair value, but we could easily overshoot.
Well, 4,300 by definition, we're in a bull market. We'll be 20% off the lows at that point.
I mean, what about policy out of this administration? Last night in the State of the Union, the president talked about fee income, giving a shout out to the CFPB director's war on so-called junk fees. They included a praise for the agency's recent proposal to cut credit card late fees. He talked about raising the stock buyback tax, quadrupling it, by the way. He talked about big tech, big pharma, big oil. I mean, these all come under the umbrella.
And cancer, throwing cancer as well.
Of a tax on corporate America. What does that mean for these companies and their expenses and the regulatory burden?
they're great things to throw out to his base, but largely most of this is not going to happen. It's just not going to. This is not going to get through the House, and I don't even think a lot of that could get through the Senate at this point. I think he's speaking his game. I think he spoke about it just a few minutes ago. Just 58% of Americans don't want to see this guy run again. So he's putting it out there. I don't think any of that's going to happen. You're talking about the idea of a recession coming in, and that's, for me, the conundrum at this point, because an inverted yield curve this steep at this point be the first time in a half century that it didn't happen. So what's the dynamic right now that I'm trying to understand that we're not getting it?
Well, and isn't there another market disruption potential because of the unwind of the Fed's balance sheet? I mean, come on, Jay, they're talking about taking $1 trillion of liquidity out of this market with unwinding this balance sheet by $95 billion a month. Does that not cause a sell-off in stocks?
Well, we were extraordinarily concerned about that about a year ago, but then we restudied the Fed's balance sheet, and they've done this thing. This is very obscure, but it's important for investors to understand this, called reverse repo. They needed to do that to keep rates above zero. So they have this 2.5 trillion contra account to the balance sheet, to the long part of the balance sheet, which they can unwind, and in fact may need to unwind to keep rates, to keep Fed funds within its narrow range. So we're not as concerned as most people about that. We think that'll be attenuated by them unwinding this reverse repo. So in other words, they're lending their securities back to the street, and they have been doing that. So that's an offset to the quantitative easing.
And that's what's holding us up.
A little bit, yeah. It's making it way less worse. In fact, most of that tightening occurred last year through open market operations and not letting the balance sheet come down. Again, pretty obscure, but it's absolutely critical. I would urge investors to study it. It's available on the Fed's website.
All right, we'll leave it there. Jay, it's great to talk with you. Thanks very much for coming in. David, it was a pleasure. Thank you so much. Jay Hatfield, David Nelson.